Borrowers struggling to borrow. Now, this is in the first part of CMAP 2. There's questions on this in the exam, but also as a mortgage advisor, mortgage broker, you'll be thinking about the kind of people you're going to be servicing, because you can't do it to everybody. Don't work that way. When it comes to marketing and promoting your business, you do need to focus yourself, and this actually might help you towards finding a niche. So I've got almost a dozen of different situations now for you, which I'm going to share with you for the next 8, 9, 10 minutes to help you to understand borrowers. So where do I start? Well, in no particular order. There's the picture of my borrower there, as you can see, and he or she, doesn't really matter. This particular borrower is relying on a guarantor, so let's put that in there for you. Now, somebody who's relying on a guarantor, so let's just put that in a little box. This is the borrower who may have no or little affordability. They might not be earning a huge amount, and therefore to afford the mortgage, to get the mortgage, they might need to get a guarantor. They might have insufficient deposit, for example, and they're therefore looking upon the guarantor to offer extra support. So let's just put our little guarantor in there for you. And they tend to be parents, so there's a little bit of hair there for you. It's a bit of a stereotype, isn't it? So that's your guarantor. Now, the guarantor, of course, needs to have the ability to cover the mortgage. The guarantor is required to make payments to all of the mortgage all of the time if the borrower fails to do so. You might have a situation where the guarantor is offering a surety. In other words, they're offering a lump sum of money. Let's put a little lump sum there for you, in order to help with the mortgage itself. And we get around this with joint borrower sole proprietor mortgages, which you'll discover later on. So that's the first borrower struggling. On their own, they can't afford it, therefore they need a guarantor. So let's go on to our next one then. What about borrowers then with adverse credit? So we're talking over here, let's put a little unsmiley face there. I'm talking here about adverse credit. Now, as we know, of course, to get a mortgage, you only need 3 things. You need to have a deposit, you need to have an income, and you need to have a credit score, a decent one too. Now, if you haven't got a decent credit score, that could be because you've had a bit of a blemish in the past, a bit of a coffee stain possibly. Maybe you've got some sort of county court judgment. It was never your fault. So maybe you've got one. We've all been there. We've all been in arrears. We've all had debts in our past. I've had 2 or 3 occasions in my life where I've been broke, but that's life, you know, and therefore it's affected your credit score. In those situations, therefore, this person will have limited options available to them. You can go to specialist lenders. We used to call it subprime lending. Don't call that anymore, do we? But there are lenders that will help, that will give you the lending, repair your credit score, and let you remortgage on to somewhere else if you wish to as well. But the interest rates are higher and the options are limited. So that's your adverse credit one there as well for you. Okay, let's go on to the next one for you. Let's get on to subprime borrowers. Now, I mentioned subprime. It's slightly different to somebody with adverse credit. I'll put it here for you. We don't tend to use that phrase anymore, but it is in the book, which is why I've got it in there for you. Subprime borrower means somebody, because of their situation, is not a prime borrower, and therefore would go to a particular mortgage lender, get a particular mortgage at higher interest rates for a period of time. And obviously somebody with adverse credit might be able to get it through a normal mortgage if it's not too bad, maybe if the county court judgments have been settled, for example. But somebody who's subprime tends to have to go to a different type of lending. But we don't like to use that phrase anymore, because the 2008 crash arguably was caused by subprime lending in the US, not so much over here as well. That's subprime for you. Now, on the same kind of topic, let's take a look at somebody who is a bankrupt. Let's put bankrupt in there. Somebody that's declared bankruptcy because of their debts, or somebody that's done it voluntarily through an IVA, a voluntary arrangement. Now, this is obviously somebody that's linked into adverse credit, so they've got adverse credit. But bankrupt's usually bigger than that. It's usually a business that they've owned themselves, or they've just got completely indebted somewhere along the line, and they've had to declare themselves as bankrupt, or got an individual voluntary arrangement going, which basically means all the people they owe money to have come to an agreement. Now, those people cannot borrow. They're not allowed to. Small amounts they can do. They can have tools for trade, that sort of thing, but they won't be able to get a mortgage. Not at all. They'll need to rebuild their credit position once they come out of bankruptcy. That's the other thing. You see, bankruptcy lasts for a year. You come out of it, you're then discharged as a bankrupt. but you're still known in this country as a discharged bankrupt. That's still not good. You have to ask the question on the mortgage application. The client must give the information. It's on the credit search. It's not there forever. So be careful if a client's had it in the past, because the question on the application form will ask if you've ever had bankruptcy, and the client must tell you the truth. And the longer the period of time beyond bankruptcy, the easier it will be to get a loan. High street or vanilla lending won't tend to touch bankrupts, well, discharged bankrupts I'm talking about, people who've come out of it. If you're bankrupt still, there's no chance. And that's a particular type of borrower who's struggling to borrow. That makes sense, doesn't it? Let's keep it going then. Let's get into first-time buyers then. First-time buyers. Let's put this person over here then. First-time buyers. First-time buyers are the lifeblood of the mortgage sector, of the housing market. Without first-time buyers, none of the flats and small houses ever get bought, which start the chains going along. And with part-time landlords, sort of accidental landlords, call them what you like, pulling out of the business, first-time buyers need to be there to take up all those properties as well. So not a problem if you're a first-time buyer, don't get me wrong, but you've got a limited credit history. Some first-time buyers don't have much of a credit report because they don't have much credit. They've not proven themselves to be able to borrow and pay back. So they've got a thin credit history. The other three things, remember, you've got income, deposit and credit report. That's what you need for a mortgage. So the credit report might be a bit thin. The income, of course, might be a bit low, but some first-time buyers are earning good money. But it's the deposit. They may not have had time to save up for a deposit. If you need a 5 or 10% deposit, that's a lot of money these days. So first-time buyers, they don't struggle to borrow, but they are a unique category of borrower that needs looking after. And they need lots of help and advice. Although a lot of them are going straight to AI now to get their mortgages, so they might not be a client that you would want to look after as well. Self-employed. Let's get into the self-employed, shall we? So I'm talking about self-employed, sole traders is one particular category here, but you could also put in here owner-directors. Now, an owner-director, she tends to be a director of her own limited company, but it's usually just her, and she's usually offering her services under the banner of a limited company. It's so she can pay her tax and do things properly. But a self-employed dude, he's running a trade, doing a trade, and he's a sole trader. Again, not a problem, but it's fairly unique. The thing about self-employed or owner-directors is their income fluctuates dramatically. It does. I've been self-employed 25 years. I know it. Some years you have a good year, some years you don't. If you're on a salary, you tend to earn the same money. Maybe a bonus, maybe an increase in salary, but it's pretty stable. Or you lose your job if there's a recession. One or the other. Self-employed is up and down like a yo-yo. Just look at COVID and the situations around that as well. So you have to show your income as a self-employed. You have to prove it. So you need to been operating for a few years. 3 years tends to be what we like. We look for net profits from a self-employed person, which is basically the profits they make from business. We're looking for a 3-year period where maybe it's going up, or an average might be useful as well. Owner directors pay themselves a small salary and dividends. At the moment, that's changing because of tax. We might find they'll just pay themselves a salary, or maybe switch back to self-employed basis. Again, you need to prove it. You need accounts, possibly. An SA 302, which is the HMRC document, which confirms people's income, is a jolly good one too. So you have to prove the income and the trading history. So again, specialist area, that self-employed owner directors. But if you can get a lender or two that specialise in that area and you get good at understanding them, that's a great niche market to get into as well. Different colour pen though, but similar I suppose, but we're talking about employed people and we're talking about contractors now. A contractor, we used to have 0 hours, but that's gone, that's been banned now. I think the legislation has gone through. But a contractor is somebody who's employed, but only for a period of time. It could be 6 months or a year. So they have an employment contract, but it's only for a particular time. So that's unpredictable for them because the contract could stop and there's no new contract renewal going on. But arguably somebody employed could lose their job overnight, so you need to take a view on the person's history, what their experience and their education is. That's contractors. Interesting. One of my favourite types of borrowing, which I'm getting involved in, are older borrowers. Older borrowers. Now, I work with a number of firms now that specialise in lending to older people, and they talk about over the age of 50 or 55. That's kind of like the age group. Now, 55 isn't old, I know that. But this is an area where traditionally people want to get their mortgage paid off on retirement. It's a very old-fashioned way of thinking, really. 67, I'm retiring. Let's go and get the allotment opened up. It doesn't happen anymore. People tend to work on or part-time. We know that. So lending to older borrowers means that you're going to be lending into their retirement or semi-retirement. So you need to take into account things like pension income, affordability assessments around their state pension, private pension, investments, maybe rental income, whatever it is. So you need to take a look at that. Older borrowers can obtain interest-only mortgages now that don't ever end. We call them RIOs, retirement interest-only mortgages. Or you can have TOs. Now, it sounds like T's, isn't it? Where you have an interest-only that's payable for a term, and then it reverts to a roll-up mortgage. Of course, you've got equity release as well. It's an enormous growth area. Do you know, I did some research. There's about 21 million people over the age of 55 in the UK. 21 million people over the age of 55. They're all grown-ups as well. And they all have money. And about 65% of those, and I'll show you the stats if you're interested, 65% own their own property. It's a huge marketplace. And one that we're getting involved in when we get ourselves up to Edinburgh in a couple of years' time. We're going to set up our own later life lending firm, financial advising as well as lending as well. So that's the older borrowers. Good one, that. No. Okay, let's take a look at a few more. Let's take a look at borrowers seeking non-standard properties. Let's squeeze that one in there, shall we? Non-standard homes or properties. Again, the borrower is good, Nick, but the home they're buying is not so good. And this could be a non-standard property. So, I don't know, maybe a flat above a shop, for example, is non-standard. Ex-local authority properties are non-standard. Something built about unconventional materials would be non-standard, like wood frame properties, that sort of timber frame properties. It could be 15-storey high blocks of flats or small leases, that sort of thing. Again, different lenders work in different areas according to their specialist area. Some lenders will focus on new build properties, on self-build properties. It could be somebody looking for a large mortgage as a non-standard mortgage, isn't it? Might come into it as well. Now, lenders do have a restricted appetite to non-standard homes because they rely on the home as their main security for the loan. That's why they lend long, isn't it? So non-standard properties could be one as well. Over here we've got self-employed owner-occupiers. What about employed people? Well, employed people, generally speaking, are okay. But if somebody's owning a lot of money and they're looking for a very big mortgage, so high income customers, I'll put down here, high income clients. Now, a high income client would invariably be on bonuses, profit share possibly, share deals, that sort of thing. Obviously a salary as well, and they'll be looking for a big mortgage as well. So you've got different levels of income as well. They do have to be scrutinised carefully, their income and where it's come from as well. We're talking about big mortgages here. It's not difficult. There's a few firms I work with call themselves private banks, private mortgage companies. Private's in the word there because high income people like to be kept private because it's a very specialist area. So that's high income borrowers, could be a borrower struggling to borrow. Maybe that's a bit demeaning calling them struggling to borrow, but you get where I'm coming from. No one over here for you. Foreign nationals. There you go. Foreign nationals or expats. They're the people, of course, that live abroad. Expatriates, effectively. They live abroad, but they're generally normally a UK resident, but not for this period of time. These people want to buy properties over in the UK for rental, typically, isn't it? That's your marketplace there. Now, they don't have a UK credit history, so there's issues around that as well. There might be visa restrictions, for example, if they're a foreign national. Expats tend to have no problem there, but a foreign national might not be able to come into the country to work. You've got to be really careful with money laundering here, particularly if money has been brought in from abroad to purchase a property here in the UK with a small mortgage. That will come into it as well. So again, that's a borrower who may well struggle to borrow normally as well. With the bankrupts and adverse credits, of course, we've got people on low income. Somebody on a low amount of income. Let's just put a little cross around that one. Again, not a problem. They just have a low income, so low mortgage will go into it. But here we're looking at limited earning capacity, aren't we, for these people who'd have difficulty meeting the criteria of the lender. So these situations, you might want to look at a shared ownership mortgage, for example, where they buy a bit of a property and the housing association buy another ones. Or it could be some government scheme, for example, available for some shared equity going on. That's how you tend to help low income people, to help them to borrow money as well. You could also have down here complex, there you go, financial histories or complex financial income. We're talking here about somebody who's more complicated than anybody else. Typically they've got multiple sources of income. So they might have bonuses, commissions from work, for example. They might have investments, rental income, bonuses, interest, all sorts of different income makes up their life. Tends to go with high income clients as well. And maybe owner directors as well might have complex types of income. And you have to prove the income for these people as well, as much as you possibly can. They often have complex structures. For example, in the buy-to-let marketplace now, in the professional buy-to-let marketplace, people often buy as limited companies now. You know, rather than individual, they set up a limited company, an SPV, to buy a property. And then you've got shareholders owned by other shareholders. You get like different companies based offshore maybe who own a percentage of this new SPV, and uncles and aunts own them all as well. It gets very complicated, and lenders are often very nervous about that sort of thing as well. A couple more for you, just to squeeze in a few more for you. Let's put one down here. Divorced. There you go. Let's put divorced couples or divorced clients, or separated. Again, not a problem. I'm not saying these people will struggle to borrow, but these people may have fewer assets because they've been divided up. The marital home would have been divided up and given to each of them maybe. Or maybe one party got one big part of it and one other party got a small part. So they may not have the deposit that they had, and they're slightly older by the very nature of being divorced. So they're not first-time buyers, but they may not be that far off from being a first-time buyer in the amount of deposit they've got. Their income might be great, but they might have maintenance payments that they're making to the ex-partner, which of course is a mandatory payment. So of course that may well cause issues as well. And the last one for you, which is connected to vulnerable clients really, and that's debt consolidation for you. Debt con, the whole word of consolidation, or debt con we tend to call them. Now these are borrowers who invariably are remortgaging. They're not buying a place, but they're remortgaging because they got a lot of debt. So you're looking here at somebody, for example, they're not adverse credit. They got a lot of debt, but they're paying it. They haven't gone into bankruptcy or anything like that. So therefore they want to reformat the debt into a mortgage, into a long-term debt. So we call it debt consolidation. So they're remortgaging to pay off their existing mortgage, but maybe to pay off some credit cards and some bank loans or whatever it is. That's called debt con. We regard them as vulnerable clients very quickly and immediately. We have to be very careful how we handle those people, because somebody who's desperate to consolidate debt is usually desperate for some reason. They're under pressure from themselves to sort this problem out and then start off afresh. It's like the 1st of January, New Year's resolutions, isn't it? Start off afresh, So that's debt consolidation. Again, it's a big piece of business. You can do that. It's no big deal. You have to find lender debt. So these are all the different types of borrower. Now, I know loads of mortgage brokers who focus their niche in one or two of these areas. I know, for example, a friend of mine who does owner director mortgages. Another friend does contractor mortgages. One of my client friends does surgeons, so that's a high income client as well. I've got other people that deal with people with complex financial histories, so surgeons and an anaesthetist who might do some private work as well as NHS work. So brokers focus on these areas for them. Subprime, of course, used to be a big area. So think about the clients that you deal with. There are a variety of them. I hope that's been a nice summary. Bye.